So good morning, everybody. You're very welcome to today's webinar. My name is Karen Bennett. I'm the Marketing Manager here at BrightPay. Today's webinar will be looking at small employers and auto-enrollment and what is the opportunity for payroll bureaus. I'm delighted to also welcome our guest speaker, Jenkins from Standard Life. Jamie is Head of Pension Strategy at Standard Life. He has worked in financial services for over 25 years, focusing predominantly on pensions, where he's involved in operations, product development, policy and strategy. He currently leads on strategy for workplace pensions and benefits and is closely involved in pension work and pensions reform, including pensions freedoms, auto-enrollment and the retail distribution review. He joined Standard Life in 1989. Now today you're quite welcome to type in any questions that you have into the questions tab there on your control panel on the right hand side. And what we're going to do at the end is try to get through as many questions as we can for both myself and Jamie. Now there is a good few people logged on today, so we will try to get through as many questions as possible. You'll also have to excuse us here today where we've been hit by cold and flus and everything like that, so sorry about the sniffles coming in. Today's webinar is also being recorded, so we will send a copy of the recording to everybody after today's webinar. So let's begin with my section, Small Employers and Auto-Enrollment, the Opportunity for Payroll Bureaus. Here is the agenda for my slot today. Just to note, when talking, I will often refer to auto-enrollment or automatic enrollment simply as AE. We will start off first with a brief introduction of auto-enrollment. What auto-enrollment means for an employer is that from their staging date or from their deferred date if they're using postponement, all eligible job holders must be automatically enrolled and the employer must make contributions to their pension. All employees must be assessed to determine whether they are eligible job holders, non-eligible job holders, or entitled workers. Eligible job holders are those who are aged between 22 and state pension age, earn above the earnings threshold, currently £10,000, and work in the UK. Eligible job holders have the right to opt out of the pension scheme after being enrolled. All other employees are either non-eligible job holders who can opt into the scheme or entitled workers who have the option to join the workplace pension scheme. In summary, auto-enrollment is something that is optional for the employee but mandatory for the employer. With AE comes a number of employer responsibilities. So 1, a pension scheme must be set up with a qualifying pension provider, and this should be done in advance of your staging date. This should not require a great deal of time, and Jamie later on will take us through a few pointers. Next, the workforce must be assessed at your client's staging date, and all eligible job holders must be automatically enrolled into a workplace pension scheme, unless they're using postponement. 3 is communications. All employees must receive communications within 6 weeks of the staging date, not just those who have to be enrolled. You must notify eligible job holders, non-eligible job holders and entitled workers, including those who have been postponed, about AE and how they will be affected. 4, ongoing duties. There are a number of ongoing duties such as handling opt-outs and opt-ins, making deductions and contributions, monitoring employees each pay period, and sending a contribution file to the pension provider. Employers or you on their behalf must also complete a declaration of compliance within 5 months of the staging date to notify the pensions regulator that they have complied with AE. As most of you already know, auto-enrollment has been rolled out in stages across all employers and started with the large employers in October 2012. By October 2018, all employers must be required to offer a workplace pension scheme to eligible job holders. By the end of last year, over 370,000 employers had completed their declaration of compliance, enrolling over 7 million eligible job holders into a workplace pension scheme. So now we're just going to have a look at the small employer market. The pensions regulator estimates this year that over 750,000 small and micro employers will need to act as a result of auto-enrollment. You will see from the slide that it is from now that is called the so-called tsunami begins, with almost 100,000 small and micro employers set to reach their staging date this month alone. A lot of companies staging before now would probably have had their own HR people or in-house accountant to help them through the enrolment process. The vast majority of those staging from now will have no in-house expertise, and the majority of these employers will have no knowledge or experience to make informed decisions when it comes to their AE obligations. With the vast quantity of information available, employers are fast becoming overwhelmed with the entire process. These clients will require help understanding the implications for them, their employees and their business. The pensions regulator estimates that 78% of SMEs will turn to an accountant, bookkeeper or payroll bureau. So you have a gift-wrapped business opportunity, and this is business you don't have to go chasing. So auto-enrollment as a service. It is estimated that 90% of an accountant's or bookkeeper's client base is made up of employers with less than 50 employees, and it is from now onwards that these employers will be affected by auto-enrollment. So payroll bureaus don't need to shy away from offering AE as a service. Bureaus will need to determine what kind of information and support they will offer to help their clients comply with these new AE duties. Advisors will even find that a large portion of employers will contact them very close to or even after their staging date. If a client does contact you after their staging date and has done nothing, and if their staging date has passed by less than 6 weeks, get them to issue postponement letters to all employees immediately. Otherwise, they will need to backdate AE back to the staging date. So be sure to convey the client benefits of outsourcing AE tasks to your clients. You could take the opportunity to inform clients about the added value, then they will be more likely to remember and understand your service offering. So one is time. There will be significant time savings for your payroll clients. By outsourcing AE to a payroll professional, your client can avoid investing huge amounts of time researching how to comply with AE. The implementation of AE could also be very time-consuming if your client doesn't have the correct technology or software in place to automate a lot of the admin tasks. 2 is cost. Without your help, your payroll clients might choose payroll software that doesn't have AE functionality. Even if it does, some payroll providers are charging an additional charge for AE functionality and a further charge to support your clients through the process. With a bureau, your client can avoid costly mistakes and save time that otherwise would have been taken out of their normal working week. 3 is focus on core areas. Especially when we look at the small and micro employers, their time is extremely precious. Time away from their business is money. Outsourcing AE to a payroll professional frees up their energies and enables them to focus on the core areas of running their business. 4 is expertise. Implementing AE may require skills that client staff do not possess. Outsourcing will provide a level of continuity to the company while reducing the risk of non-compliance. By offering a complete end-to-end solution, bureaus can generate income and enhance client relationships. If bureaus offer other services such as bookkeeping, tax returns, audits, managed accounts, etc., they will have a new platform to reach and upsell to this new audience. You will find that employers will be happier to consolidate all of their outsourcing services to one person or advisor. The responsibility for complying with the employer duties does rest with the employer. The pensions regulator will enforce penalties if the employer chooses to ignore their auto-enrollment duties. The enforcement action starts with statutory notices being issued to the employer. This is then followed up by penalty notice, and further non-compliance may lead to court action. The pensions regulator wants to work with employers to make sure they understand their employer duties. In certain circumstances, they will work with the employer to ensure compliance. For example, when the employer genuinely did not understand their duties or due to unforeseen circumstances have not been able to comply. However, those who do not carry out their AE duties in accordance with the law will face enforcement action and penalties. The pensions regulator will investigate willful and non-willful compliance. They are within their rights to carry out inspections and request certain information from employers. The regulator have a whole array of fines and actions that they can carry out with regards to non-compliance, which you can see on the slide. I'm not going to go through each one in detail, but auto-enrolment should actually be quite easy to comply with, so you shouldn't need to know too much of these in detail. There are three main sources of intelligence that the pensions regulator rely on when deciding if it should take further action. So one is receipt of a declaration of compliance. If the declaration is not received within 5 months of the staging date, then it is usually a good indicator of non-compliance. 2. Notification by a pension scheme of non-payment of monthly pension contributions. In such cases, either pension files have not been submitted by the employer or the employer has not discharged the amounts deducted as per these files. 3 is employee whistleblowing, e.g. if an employee has been advised by the employer to opt out of auto-enrolment, this represents a serious breach of regulations. There have been over 20,000 AE cases closed to date. This includes over 26,000 compliance notices and almost 7,000 fixed penalty notices. A full breakdown can be seen on the Pensions Regulator's website. You can be rest assured that these numbers will ramp up once the small employers enter the fray. One of the main reasons for actions by the Pensions Regulator to date is due to employers missing their staging date. If you realise that you missed your staging date and are within 6 weeks of that date, you can postpone auto-enrolment. All employees must receive communications within 6 weeks of the staging date relating to the postponement and explaining when they will be reassessed. If this communication is not issued, then postponement effectively never happened and enrolment must be completed retrospectively back to the staging date, which in itself would be a nightmare. If you are outside the 6-week period, then it is too late to postpone the staging date. Instead, you must assess staff on the staging date, backdate their enrolment date to the staging date, backdate any missed contributions. In this case, make sure to complete the following steps. So get in touch with the Pensions Regulator. The Pensions Regulator issues fixed penalty fines to businesses who do not complete their auto-enrolment duties, and missing your staging date is one of these duties. However, they do treat each case differently. The quicker you get in touch and depending on your situation, the better positions you will be to avoid a fine. Register with a pension provider. You must choose and register with a pension provider that is suitable for your employees. Be aware that not all pension providers allow you to set up a pension scheme if your staging date is already passed. Assess your employees. Before you can bring your scheme up to date, you will need to assess your staff to establish if they are eligible for automatic enrolment. Any eligible job holders need to be enrolled. Communicate with your staff. Another employer duty is to inform your staff. You must communicate with all workers, including non-eligible job holders and entitled workers. Your payroll software should automatically be able to prepare these letters for you. So backdate any missed contributions. In order to become compliant, you will need to pay contributions for all employees who are eligible and who have opted in. Importantly, you will need to pay these contributions as of your staging date. You will need to use the previous payrolls for any missed periods to calculate any missed pension contributions. And complete your declaration of compliance. Before you can officially become compliant, you'll need to complete your declaration of compliance for the Pensions Regulator. So review your existing payroll systems. So here at BrightPay, we understand that auto-enrollment is a daunting task for bureaus. Payroll bureaus don't need to shy away from offering this as a service, and having the right payroll tools will play a fundamental role in ensuring the success of auto-enrollment. While there is no legal obligation to have software in place for auto-enrollment, the pensions regulator encourages employers to use an integrated payroll and AE solution that can automate employer duties and simplify the AE process. With a combined payroll and auto-enrollment solution in place, bureaus will benefit from greater efficiency, increased value, and improved cost savings. Ensure that your payroll software provider will provide all of the necessary functions to automate the employer admin tasks, and you should test it well ahead of reaching your staging date to make sure it works. Some payroll providers have auto-enrollment functionality, but it can be cumbersome and time-consuming, while others offer a streamlined solution that will automate the AE duties for you. So make sure to do your research. The speed of automated AE software offers both significant cost savings and time savings benefits to bureaus. This will be especially relevant when we look at these employers who approach their payroll bureau close to at or even after their staging date. AE does not need to be a major headache for bureaus, provided you take some time to make sure that the right tools are in place. AE should be a seamless part of your payroll process. By making sure that your payroll does the following functions, it will allow you to streamline your processes and start making a profit from AE. So does your software automatically assess your workforce, allow the use of postponement, automate employer communications, calculate pension contributions, handle opt-ins and joining, handle opt-outs and refunds, notify you when actions need to be taken, keep records and provide reports, integrate with some or all of the major pension scheme provider systems, and lastly, provide free support. If you are selecting new software, you should ensure that it is compatible with your existing systems. So now we're going to have a look at how BrightPay handles auto-enrollment. BrightPay is an integrated payroll and auto-enrollment solution that will automate and simplify the AE process. We really try to make it as easy as possible for you to help your clients achieve compliance while saving you both time and money. So I'll now hand you over to my colleague Rachel, who will show you just how easy auto-enrollment can be with BrightPay. We will also take a quick peek at BrightPay Cloud, which is our latest add-on product. So thank you, Rachel.
Thanks, Karen, and hi everyone. So the first thing to do in relation to auto-enrollment is to enter your staging date into the payroll. So this can be done under the Pensions tab, and I have the staging date in here as the 1st of January 2017. If your staging date isn't entered, you can connect to the pension regulator to retrieve your staging date, and this is through an API so that it will automatically pre-populate in the software. So I'll leave that as the 1st of January. Also ahead of the staging date, you can add your pension scheme. So this is very straightforward. So up here at the top, we'll click Add New Scheme. And there's currently 17 pension providers to choose from that BrightPay currently is compatible with. There is also an other auto-enrollment scheme option if your chosen pension scheme is not on the list. So today we're going to use Nest as our pension scheme. I also have a Nest scheme set up here today. So when setting up your scheme, you have to enter your employer reference, choose your submission method. So this would be whether you want to use the Nest web services or whether you want to manually upload the contribution files through a CSV. And in the next tab then, you can enter your group name, you can add your contribution type and select the earnings basis. Here you can also add further groups if required. For example, if you have employees on different pay frequencies or sets of employees on different worker categories. So I'll just save the changes there. If we go back to the payroll now, as soon as we reach our staging date, you will see these flags appear. So we click into an employee, these alerts will bring you through to the relevant actions available to the selected employee's worker category. So at staging, BrightPay will automatically assess your workforce for you and determine whether they are eligible job holders, non-eligible job holders, or entitled workers. So for an eligible job holder here, we can click into the options. So we can enroll them into a qualifying scheme, we can postpone them for up to 3 months, or we can mark them as exempt. So we'll click enroll here. Simply choose the scheme you wish to enroll them into, and choose the tax relief and click continue. BrightPay will then automatically prepare the employee's enrolment letter, and this can be printed, exported to PDF, or emailed directly to the employees, and again we'll mark it as done for the employee once we're finished with it. So you'll see now their flags disappeared there, and their pension contributions are showing up in the live calculation of their payslips here. For a non-eligible job holder then, we can click through here, and the options for this employee are different. So for a non-eligible job holder, we can print or export the right to opt-in letter, opt into a qualifying scheme, postpone or mark as exempt. And similarly for an entitled worker, the options are slightly different in that it is the right to join letter instead of the right to opt-in letter. So if we decide to postpone an employee, for example, we can click postpone. We can choose the deferral date first of all, so this can be any date within 3 months, and we click continue. There's also the option to postpone multiple employees at the same time, so I'll click here and I'll click a few of these to postpone. Again, BrightPay will automatically prepare the enrolment letter, or the postponement letter, sorry, and again this can be printed or emailed to multiple employees at the same time, and again I'll just mark it as done here. BrightPay also handles batch enrolment, so I'm actually going to change Carla's salary here, so you'll see she has now changed to an eligible job holder. So again we'll go into view options and we can enroll, choose the scheme again, and rather than do this for each individual employee, we can enroll multiple employees with these settings. So I'm going to take each of those that are remaining there, and again these letters can be marked as done. Okay, so going back to the payroll now, you'll see the pension contributions showing up for each of the enrolled employees. And if I finalise the payslips and go into print preview, so this is what the payslip looks like, and you'll also see that there is the deduction in this pay period, and there is the year-to-date pension contributions as well. Okay, so BrightPay also allows you to prepare the enrolment and contribution files for each of the 17 pension providers that we are compatible with. So you'll see number 2 here at the Pensions tab, which means we have 2 outstanding files to be sent to the pension provider. Okay, so to send the enrolment summary, we'll choose this at the top of the screen and click Send Enrolment Submission. So I'm just going to ignore that there. Okay, so we fill out each of the following steps accordingly. So I'm just going to enter the payment source as direct debit. And this must be exactly as it appears with Nest. And I'm going to copy this to all other employees just to pre-populate it. And we'll simply click Send now. So at the moment we do have an API with both Nest and Smart Pensions. We don't have one yet with Now Pensions, or sorry, Standard Life. But once you click Send now, it will automatically send your contribution through to Nest from within the software. The contribution summary then, choose the file or the pay period we wish to send the file for, and click Send Submission. Again, we fill out each of the following steps, so the payment due date, and simply again at the end click Send now, and it will automatically send it through to Nest. If an employee decides to opt out, we can click into the Employees tab, choose the employee and click Auto Enrolment and select the Opt Out option. So we enter the opt-out date and, if applicable, the opt-out reference and click Continue. Yes, so that's Amy opted out there. If we go back to the payroll now and on to the next pay period, you'll see that Amy has got a refund of all contributions made to date. So the final thing to look at in relation to auto-enrollment is the analysis. So with BrightPay there is a report builder where you can build your own reports. So you'll see I have a report open here, so we can click New, Payroll Report, and we can choose the period we want to include, the employees, and each of the columns. So under the columns here, we can choose to add a few auto-enrollment options. So we can tick to get a nest report here. So tick each of those there. And when I run the report, you'll see all of the totals and the breakdown for each employee of all the nest contributions. So that's it for the BrightPay and how BrightPay handles auto-enrollment. I'm now going to show you a quick look at BrightPay Cloud. So this is our new add-on product, and it is an online self-service portal which enables automated backups and online accessibility. This is an optional add-on to the current software, and although the payroll information is stored online, you will still need to have the desktop software where the payroll can only be processed on the desktop. So once you have set up BrightPay Cloud and connected the employer to the cloud, you'll find a green cloud icon at the top of your screen. BrightPay Cloud automatically and securely backs up your payroll data to the cloud every 15 minutes, and again when you close the employer file. This will ensure that you never lose your payroll data again. BrightPay Cloud keeps a chronological history of all backups that can be restored at any time. If we open the self-service portal, you will see the online employer dashboard. For bureaus who offer payroll services to a number of clients, you can add your client as a user so that they can log on to the employer portal. These employer clients will then be able to log on to their employer dashboard at any time using their PC, Mac, tablet or smartphone. This employer dashboard can be branded with the bureau's details and enables the employers to view payroll reports, P30s, employee calendar and all employee information. So employers and bureaus can view all employees in the employer data file with the ability to click on an individual employee to view a full history of each of their payslips. Reporting is also integrated with BrightPay Cloud. All reports set up in BrightPay can be viewed from within the employer portal, allowing employers to access reports on the go anytime. So if I click into your report here, you will see that these reports can be exported or modified, and this report is useful for bureaus whereby the employer can view these reports without the need for the bureau to send them to the employer each pay period. The self-service portal also includes an employee calendar, and this allows the employer to view all past and scheduled leave, such as annual leave, sick leave, and statutory leave for all employees. P30 details are also included, with a record of HMRC payments and amounts due to HMRC. BrightPay Cloud also allows users to upload BrightPay 15-16 data to immediately have a full year of historical data to power the self-service features. Along with all the employer functionality, BrightPay Cloud provides bureaus with a multi-company platform where they can view each of their companies. Multiple users can also be added to access these companies. Here, bureaus can grant access to other co-workers to view multiple companies, or this is also where bureaus can add their clients to view company-specific payroll data. As I mentioned previously, bureaus can also brand BrightPay Cloud by adding their company logo and their company details, and this will help improve the bureau-client relationship. So if I close this down now and we will view the employee self-service. So this is what it looks like for employees. It looks quite similar to the employer dashboard. However, employees are limited as to the information that they can see. Employees will get notifications when payslips and other payroll documents are available. If we click into the documents then, they can view a full history of each of their payslips. P60s, P45s, P11Ds and auto-enrollment communications can also be viewed in the Documents tab. We can click into a payslip here, and these can be viewed or exported by employees, and this is without the need for the employer or the Bureau to print or email the payslip each pay period, reducing your workload. Employees can use the self-service portal to view and update various personal information, such as their phone number and postal address. And the Calendar tab will allow employees to view their calendar, including past and scheduled leave. Employees can also request annual leave through the portal. So by choosing the relevant dates and clicking Submit, the employer will automatically get a notification that the employee has requested leave. So going back again now to the employer dashboard, you will now see that the employee's leave request is coming through on the notifications panel with the option to approve or reject the leave. So if we approve the leave here, and if we click back into the calendar, you will now see the leave appearing in both the employee and employer portal. The leave will also be automatically synced back to the employer data file on your PC. So this was a very brief overview of BrightPay Cloud. We do have another few features coming down the line which are in work in progress. For example, the employer will be able to upload timesheets for their employees, and this will automatically flow through to the Bureau's dashboard to process the payroll. There will also be the option to upload other documents as well as the payroll documents, for example, an employee's contract of employment or staff handbook. You can find more information and videos about BrightPay Cloud on our website. We are also running free online demos of BrightPay Cloud, which look at everything in much more detail, including setting up a BrightPay Cloud account, connecting your employer file, adding other users, and annual leave requests. So we will include a link to register for a BrightPay Cloud demo in the follow-up email later today. Thank you.
Okay, just before we pass you over to Jamie there, just to note in the BrightPay demo, while we did use Nest as an example, it's exactly the same setting up process with Standard Life, and your contributions will be visible on the payslip, etc. BrightPay does produce customized files for Standard Life to allow you to easily export your data and import it into the Standard Life portal. So I'll now pass you over to Jamie Jenkins, where he'll take you through the wonderful world of pensions.
Thank you very much, Karen and Rachel, for going through the various aspects there. And there's a few things you've touched on around pensions, and we'll build on that. I'm joined by my colleague Graham Bell. Graham is the true expert in the room here. He leads on Standard Life's development of our auto-enrolment solution and has done for hundreds of years, Graham. Is that hundreds of years, he tells me. My role is primarily around the sort of policy development, so I spend a lot of time speaking to government and regulators about how we develop the policy around automatic enrolment, and I'll not bore you with hours of thoughts on that and the politics of it, but maybe just touch on it as we go through. Just to quickly reiterate, there was a few numbers there mentioned by Karen, which I entirely agree with and are quite important, I think worthy of a second mention. We have now 7 million, just over 7 million people automatically enrolled, around 370,000 employers. It's been recently sort of dubbed on the back of a piece of research as one of the most successful savings policy interventions ever by government. So on that basis, I think you can probably assume it's relatively safe as a continuing piece of work that the government will want to see through to conclusion. It does reach its conclusion this year in terms of broadly covering all employers. Again, a number I'd agree with, about 750,000 employers over the course of this year will set up a scheme, hopefully, or certainly should have to set up a scheme. It is interestingly as well, I think it's important just to reflect another point that was made earlier, is it it's not compulsion on employees. There is no compulsion for an employee to stay in the scheme, but it is effectively compulsion on employers. An employer must do a number of things at a certain time, including setting up the scheme, putting people in and so on, and that employer of course must contribute in the event that those employees stay in. So some people talk about, is this compulsion, is it not, is it soft compulsion? I would argue it probably, soft compulsion is probably a good word for it. It is compulsion on the employer and not the employee, and if it continues to be successful, I think we can assume that it will continue to be a nudge rather than a sort of mandatory requirement for all employees. So on that note, I'll just touch on a few things that we can cover today, and hopefully we can add to some of what's been said. So we'll talk a little bit about who it applies to, when it applies, what sort of duties there are on the employer, and I think importantly the types of cost involved and also the benefits. I think within that it's worth saying one thing that hasn't, I don't think, been mentioned this morning, and I think is quite an important element, is the potential cost saving of a thing called salary sacrifice, which I suspect will be very familiar to those of you who are accountants listening to this, but may not be that familiar to many small firms if they've not been using it for any other purpose or not had a pension scheme before. But salary sacrifice, although not widely used among smaller firms, it's increasingly of interest, and certainly a way of either employer saving money or for you as an accountant to demonstrate how you can add value in saving your client money. So we'll touch on that as we go through as well. So I'll bring in Graham at this point. These are terms that, again, you will have seen in the slides from my colleagues earlier. So who does it actually apply to? And maybe just to touch on what these things actually mean, Graham, if you can elaborate a bit on that.
Yeah. So one thing to bear in mind throughout all of this is that all these auto-enrolment rules are a new minimum standard. There's lots of things that you can do as a business yourself and advise your clients on to exceed those minimums, typically with the objective of either reducing the employer's costs, simplifying the employer's admin, or increasing the underlying value of the whole pension scheme to the membership. And when I say it's the minimum standards, one of the underlying rules that covers all of auto-enrolment is about assessing and auto-enrolling your employees into a pension scheme. The key bit being if they're not already in a qualifying scheme. And I'll talk about that several times throughout this, because already in a qualifying scheme exempts the employer from a whole heap of duties. And there's many employers, as a shortcut, will find other ways of putting employees in a scheme and making them existing members, avoid some of the complexities. So existing members, getting employees into a scheme, perhaps by contract joining the day they join the business, by accepting the contract, you automatically put them in a pension scheme. You've immediately avoided the need to assess them beyond saying they're in a pension scheme. You don't have to auto-enroll them, you don't have to postpone them, you take a whole pile of work away. But that has to fit with the employer's agenda. By doing that, you put everybody in a scheme. Whereas if you do the full-blown assessment, you're going to end up with three outcomes. Eligible job holders, the people that always have to be automatically enrolled. Your non-eligible job holders who have the right to opt in, and if they do, the employer must contribute. And your entitled workers, which are your low-paid end of the scale, they have the right to join the pension scheme, but any employer contribution is voluntary. So understanding your employer's objective, does your employer want to get everybody into the pension scheme as easily and quickly as possible? Or does the employer only want people in the pension scheme they absolutely have to? And I guess the answer will differ between employers. Some employers will be doing it because they have to, some will be doing it because they see the value of pensions as a benefit. And understanding where your clients fall will be key.
So, Graham, just a quick point on that. So kind of existing members, obviously people within a pension or people that you could effectively exclude from auto-enrolment because you've got some arrangements in place that could be termed as qualifying, fine. The eligible job holders, so those you auto-enroll, kind of that's your people earning over 10,000 and over 22.
Yeah.
Effectively your core kind of population. What's a typical sort of non-eligible? Is that?
So yeah, so as you say, £10,000 earnings per annum and 22 makes you eligible. Non-eligible is basically people earning less than 10,000, but not entitled, which we'll come back to, and under 22.
Okay.
Typically is your typical population. Your entitled workers are pretty much everybody who earns under the lower earnings threshold.
Right, okay, got you.
So they're very low paid, below 5,770, I think the number is at the moment.
Okay.
It's mainly driven by earnings.
Excellent, okay, thank you very much. That's helped me out. So, yeah, just, I mean, maybe touch on when, because it's easy to say staging date, and it's now become fairly commonly understood phrase, certainly in the pensions world, but there is some sort of flexibility around that as to what it is, isn't it?
And it kind of ties back to my point again about the minimum. Staging date is the latest date that employer duties commence. There's nothing to stop an employer going a little bit early and enrolling people into the pension scheme in advance. Again, it's a bit of a shortcut, so they can ask people, they can invite their staff to apply, they can do contract joining, and get things up and running in advance. However, if they choose to do the absolute minimum, the staging date is when everything kicks off. For most clients, it's going to be the 1st of the month. 1st of February, for example, is a staging date. There's no flexibility around that. You cannot delay your staging date. Common misconception. The staging date is set in stone. You can bring it forward, but you cannot delay it. Postponement allows you to delay auto-enrolment only. So the act of enrolling somebody you identify as eligible can be postponed up to 3 months. That's the only thing you can postpone. You still need to get a pension scheme in advance for your staging date. You still need to offer people the opportunity to opt in, but you can choose to delay the date you actually ought to enroll people by up to 3 months. Typically, it's used by employers to align things with their payroll cycles. As I said, staging dates are always the 1st of the month. If the 1st of the month isn't a date that suits that employer's business, that doesn't suit the payroll cycle, they might use postponement. So for example, Standard Life, our monthly payroll cycle runs from the 16th, say 16th of January to 15th of February. When we enrol staff, we want to enrol them on the 16th, so it's a whole pay period. So Standard Life typically uses postponement to the 16th just to line pension up with the payroll cycle. Weekly employers, monthly employers, 4 weekly paid employers, they can all do their own thing. And you can even use different postponement for different segments of staff. So if you have any clients that have a mix of monthly and weekly paid staff, you can postpone different individuals to align them with their own payment cycles, which is typically the main reason you use postponement. It is a maximum of 3 months. The other times we see postponement used, some businesses with high turnover that kind of operate a probation period, you can use postponement to a point. As I say, it's only 3 months, but it gives you a degree of flexibility if you've got very high early turnover of staff. It's another thing in the toolkit that some employers would use.
So it's a good point, and one not to get caught out with, because I have heard that people saying it's okay, you can do it 3 months late. That's not actually the message. So what we're saying here, and actually the slide is very clear in that respect, I suppose. Your staging date, you must set up the scheme. People must know that they're able to join. But your postponement, you could auto-enroll 3 months later. So if you're 1st of March, you could say, look, I'm not going to enrol till what, 1st of April, May, June.
Yeah.
But I still have to tell people 1st of March that there's a scheme available should they want to join it. So,
absolutely.
Okay.
Another thing about postponement, bear in mind that postponement continues to be a feature beyond staging date. So when you hire a new employee, you can likewise apply postponement from their date of joining company. The postponement will be a feature that typically rolls on for all new employees when people first turn 22, so when people first become eligible in the future on the 22nd birthday. Again, you can use postponement to line up with your payroll processes.
Okay, thank you. And in terms of then the duties, and this plays directly on from what we've just talked about, what does the employer actually have to do in practical terms?
So we kind of touched on that earlier. So the big one that can't be postponed is communication. There's some prescribed things that employees must be told from staging dates or from when they join the company. There are templates out there that do that, and you must issue within 6 weeks of either your staging date or the person joining the company. Lots of clever things you can do here. You can incorporate that. One of the main things that might save you and your clients a ton of effort is you can incorporate those communications into other things you're sending employees anyway. So if you have a pack that you send to new hires, you could stick your template in that pack and just make it part of your standard recruitment pack. It doesn't have to be a standalone communication. There's certain things you have to say. There is a pension scheme, you will be enrolled, you have the right to opt in. There's some prescribed content, but there are different ways of presenting that to employees. It's something to bear in mind. One of the communications is about postponement. If you are using postponement, if you are going to delay when you enroll people, you must tell them in advance. And I think Karen touched on earlier, you have to do that within 6 weeks. If you do not, postponement's off the table, and you have to enroll the member of staff from either the staging date or the date of joining company later. So getting those communications out in time is really time sensitive and really important.
Okay.
Then, after that, once you've identified the people who need to be enrolled, you have to enroll them. If they opt in, you have to enroll them as well. Once they're in, they'll get confirmation from the pension provider they've been enrolled. They'll get all their options explained to them, the main one being their right to opt out. They cannot exercise until after they've been enrolled. That's one of the pieces of legislation. And then you must start paying contributions, and paying contributions every single payroll frequency. Paying contributions is probably the biggest burden. This is the thing that you're going to have to do 52 weeks a year, 12 months a year, every 4 weeks, whatever the payroll frequency, you've got to stay on top of. And the final one worth mentioning is ongoing assessment. Assessment isn't a one-off thing that you do at staging date. By the letter of the law, that assessment of your workforce has to happen every single pay period. Now, it's very easy if everybody's already in the pension scheme on a qualifying basis. The assessment is simply they're already in. If you've got any members of staff who are not in the pension scheme because they're not yet eligible or they're a new hire, that assessment process has to be repeated to see if they've crossed one of those lines. They're now earning £10,000, they're now 22, and you need to auto-enroll them.
That's a particular issue really for firms, especially bigger firms where they have a lot of people on fluctuating hours and earnings, isn't it?
Yeah.
Where you could become eligible, having not been eligible first time around.
Correct. That's a good point. If you've got anybody floating around these earnings thresholds, because you're assessed at, I say £10,000, that's the annual equivalent, you actually have to assess them on their pay period earnings, what they earned in any given week or any month. So if you've got people earning around about £10,000, but it fluctuates because they work hourly or they do overtime or shifts, you could find 1 week they're eligible, next week they're not. So that assessment to figure out when you ought to enroll them is key.
Okay, thank you very much. If an employer sitting there, or indeed there's a client of one of the payroll firms, accountancy firms that's listening and thinking, well, they're already late, or in fact you've just highlighted something that hasn't been done. I mean, what's your sort of general advice to employers where they're in that position?
So, yeah, I guess the key thing is to sort out as promptly as you can and as proactively as you can. From the pension regulator's perspective, they're looking for any that's avoiding things, and in particular looking to avoid any detriment to the employees. Because at the end of the day, this is about making sure employees get self-enrolled, they get a pension plan, and ultimately they get a pension pot that they can retire on. So that from the regulator's perspective, any late or missed payments, that means that person, the individual, is going to be worse off at some point, is the things they're really concerned about. So a typical recovery plan is sort it as quickly as you can, find a pension provider, such as Standard Life, that will take late stages and make good on the contributions. So if you've missed 3 months, pay those 3 months. Chances are if the regulator did then look at that in any detail, they're going to conclude you've done the right thing. Okay, you're a wee bit late, but you've done the right thing, you've paid the right contributions, the members are no worse off. If anything, you might get a little enforcement notice saying, don't do it again. Whereas if you actually miss the payments, that's when you start heading to the territory where you might get a penalty. And still told to make good on the contributions. At the end of the day, the TPR is not going to leave the membership worse off. So my guidance would be as proactive as you can to get it sorted and make sure the member got every contribution they should have into their pension plan.
The real target, I guess, for the regulator is willful non-compliance, as they put it, so employers genuinely trying to get out of their duties or simply neglecting those duties, whereas actually mistakes, I think they look a little bit more favourably on if they're put right quickly. Interesting, just to reflect again on some of the numbers from earlier, Karen mentioned, I think there's something in the region of 26,000 enforcement notices, if you like, that have been issued by the pensions regulators. So generally, they, unto themselves, don't mean a fine for the employer. It's a kind of nudge to get things done, a bit of a ticking off. But there have been around 7,000 fixed penalties, which is the £400 fine for doing something wrong, which is not insignificant. It's quite a large number of employers. A slightly smaller number of what they call escalating penalties, around 700. This is where the regulator effectively decides there's a problem and it continues. That problem's continuing, and they have the power to charge or to fine, if you like, anything from £50 to £10,000 a day, depending on the size of the employer. So that's where I think they're typically, concerned about willful non-compliance, and they're doing something about it. But they're a bit more rare.
Yeah.
On that subject, the cost to the employer, and then we'll maybe touch on benefits as well, Brian.
So yeah, the cost to employers, assuming they've avoided all the fines and done things in a timely manner, there's a number of things that will factor into the employer's costs and ultimately the member outcome, the size of the member's retirement pot. And this is one of the key areas in effectively the employer's design of their scheme, where I would imagine you guys in particular could add an awful lot of value. So contributions as an example. There are minimum contributions, and they can be as little as 1% employer, 1% employee pension contribution. But that's not going to do the employees an awful lot of favours. They're not going to retire comfortably on that. And we would always encourage the employer and the employee to consider paying more. How you pay contributions can be very flexible. For example, Jamie touched on it earlier, salary sacrifice. Although the minimum is 1% employer, 1% employee, you could pay a 2% employer contribution on a salary sacrifice basis as an alternative. The big benefit there is the employer will typically save 13.8% national insurance contributions. That's an immediate saving for the employer. And assuming the employee reinvests their own national insurance contributions, the savings they make, the employee contributions topped up by 12%. So something as simple as salary sacrifice, which I acknowledge would probably require a little change to employment contracts, a wee bit of upfront effort, can have that double benefit of reducing the employer's costs and topping up the employee's pension contributions.
We're seeing more employers, just on that subject, more employers now using salary sacrifice.
Absolutely. I mean, if I roll back 12 months to the larger employers, where there's pensions managers all over it, it was quite common. But when it came to the smaller employers stage over the last year, it was a single-digit percentage. 4 or 5% of employers were thinking about it. But certainly seen with our clients, since we started supporting them through this, it's jumped up to 28%. There's some real value in that for both the employer and employee.
It's about 1 in 4 employers now.
It's about 1 in 4
yeah.
Now choosing to do salary sacrifice. Thinking ahead, the contribution, I said the minimums are 1%, 1%. The contributions do phase. They will increase from next year up to a total of 5%, and then the year after up to a total of 8%, depending on exactly what pension will pay definition they choose. So the contribution amounts are going up. So that 13.8% saving for the employer will go up with that. 13.8% of 1% is not an awful lot. By the time you get up to an 8% contribution, it really starts adding up. So getting that in place as part of the scheme design is a key area where I would encourage you to speak to your clients. Cost of administration is also another key consideration. Do think carefully about your choice of pension provider. Exactly the same way as choosing something like BrightPay to do the auto-enrolment services, making sure you've got the right pension administration there, somebody that's got a robust, reliable process can make a big difference. Because pension scheme admin is not light. At least once a month, the employer is going to have to touch the pension scheme in some shape or form, even if it's just making payments. You need to be sure that's going to run smoothly. There's consultancy costs. The likes of yourself, there'll be some charges associated with that, and there may be provider costs. Now, so provider costs will vary. Typically, there'll be a charge to the members, sometimes referred to as fund management charges or annual management charges, covered entirely by the members. Those charges are steeped in regulation and are capped. They will never be more than 0.75%, so a fraction of a percent. So the members are reasonably well protected.
That's 0.75%
each year. That's an annual cost of the funds under management typically. It's a fraction of a percent. And there might be some employer costs. There might be some level of ongoing admin charge for the employer. Sun Life has an admin charge, but we don't have any upfront charges, for example. Other providers might have an upfront charge and an ongoing charge. It will vary between providers, so it's definitely worth checking to make sure you understand what's all on the table.
Okay, thank you very much. And just finally, Graham, this slide was really just to pull out some of perhaps the more positive elements of it. A lot of this seems quite burdensome for employers and so on, but there's actually a goal at the end of this, which is people retiring, and there's differences that people can make way beyond just the sort of basic having a scheme in place concept.
This comes back to some of my earlier comments. It's really important to understand what your client's objectives are. Is it doing the absolute minimum at the minimum cost to just comply with the rules? Or are they actually looking for a valuable benefit that's going to allow their employees to choose to retire when and where they choose? And just like your payroll providers, pension providers don't offer all the same service. Some providers will offer you the absolute compliance minimum that does nothing more than give you a scheme and accept contributions. Others will provide the whole package of services that will support the member through the lifetime of the plan. The kind of things that make a difference is, we've already touched on, for example, making sure the contribution basis is right. So salary sacrifice reduces employer costs and tops up the employee's contributions. An extra 12% from the employee from the national insurance savings is transformational. It's the kind of thing that will make their pension pot significantly greater at retirement. I talked about contribution phasing. There are a couple of phases set down in legislation. in 2018 and 2019. It'll take the contributions up to 8%, but it's widely known and accepted that that's just the starting point. Contributions, if people are going to have quality retirement, contributions will need to keep nudging up. And having a pension provider that engages with employees and encourages employees themselves to think about the contribution levels, perhaps doing little incremental steps on an ongoing basis, nudging their contributions up, is the kind of thing that will significantly boost the retirement pot. Guide them through some key decisions in the lifetime of their plan, such as picking appropriate investments, depending on their attitude to risk and their closeness to retirement, and how they can take their benefits in retirement, actually being able to choose how they take their cash, their annuities, whether they take it before they retire, at retirement. There's so much choice in there, but they are decisions that can, over the lifetime of a plan, make a difference between having a pot and have a significant retirement pot.
Graham, thank you very much. That's very useful, and we shouldn't forget about that. Just to close, and I'll hand back to Karen in just a second, just to say briefly that the kind of stuff that Graham was just talking about there is really exactly what the government will seek to review this year. So they announced just before Christmas that they would have a review of auto-enrolment, 5 years into the programme in its sort of final year of employer coverage. That review will look at how we engage people in the levels of savings and where they're invested, and so on. It will also look at the contribution rates, so what happens in future, and should they go up further, or should there be further nudges to encourage people, and so on. And of course, in the backdrop of pretty difficult economic times for the country, but they will certainly look at that sort of balance of people's need to save. And they'll also look at the sort of coverage. So there is approaching 5 million people in the UK who are self-employed, who by definition don't have an employer to auto-enroll them, and the people who are lower paid or have multiple jobs which in themselves are lower paid. Those sorts of questions will be asked in a review over the course of this year, so watch this space. Happy to take any questions. There's some details there of where you can go to find out more about Standard Life's workplace offering for employers and indeed accountants. And yeah, thank you very much for the time and for listening. I'll hand back to you at this point, Karen. Thank you.
Thanks so much, guys. Just give us a second here and we'll just get set up for questions. So there's a good few questions coming through. So again, if you did have any questions about either presentation, please enter them into the question tab, and we'll try to get through as many questions as we can. Okay, we actually we had an interesting question in here, and we tried to actually find the answer on the Pensions Regulator website, so it's a bit unknown, but maybe the guys in Standard Life might know. By 2018, when a payee scheme is set up, will the Pensions Regulator get in touch with the employer automatically, or how does this work? We couldn't find anything there on the Pensions Regulator's website. Guys, have you come across that question before?
Yeah, we have. So the Pension Regulator is looking at this at the moment. We actually had them on a visit here just last week. So once we get to October 2018, the rules will change slightly, and for any new business, auto-enrolment duties, effectively their staging date, will kick off the moment they employ a member of staff. So it will no longer be based on when they first do PAYE. So it will be an immediate duty. Mm-hmm. The TPR will not necessarily know in advance, so they'll be dependent on other sources of information such as registration to see if people have done things on time. So they've not yet explained how they intend to engage with these start-up businesses, if you like, to tell them that, by the way, as soon as you employ somebody, here's one of your tasks. So they've not fully covered that.
Starting to turn their attention to it there, yes.
Just starting to turn their attention now, because it won't take effect until 1st of October this year. But there's certainly an intention that as soon as the first employee is hired, duties immediately kick in. Still, they will be introducing postponement. The rules as they stand today say no postponement for these clients, but they did confirm last week that postponement will be back on the table, so you'll have that 3-month window. So watch this space, I guess, and there'll be some further detail to come out throughout this year from the regulator on exactly the practicalities of notifying start-up businesses of their duties.
Okay, thanks a million. Sorry, I forgot to mention we're also being joined by Victoria, who is our support manager here at BrightPay for the more techie kind of questions.
Good morning, everybody.
So the next question is for us at BrightPay. Can BrightPay be branded as a bureau?
Yeah, so the software itself cannot be branded to the bureau, so it can be branded to the company, so on a kind of a company level, so the company logo, company address, etc. can be added at, I suppose, in our software itself. The cloud, however, so BrightPay Cloud, however, can be branded to a bureau's organisation. So yeah, if you're using BrightPay Cloud, that can be done.
Okay, great, thank you. So another question just in relation to BrightPay Cloud. Can you import timesheets into BrightPay Cloud? It's one of the things that I suppose we've had a lot of requests for, and the developers are working on adding that facility. So hopefully over the next 3 months we're hoping to add that as a feature to BrightPay Cloud. So a question for Standard Life there. What are the costs for Standard Life for an employer to set up?
So Standard Life, there's no set-up costs. We charge nothing to establish a scheme. The chart costs after that will vary between clients depending on their size of premiums and a number of other factors. But typically they'll be paying somewhere between 50 and 100, the employer would pay between 50 and 100 pounds per month. Right now there's a special offer on, and most folk will only pay £50 per month. The only other charge is the member charge, the charge the members pay themselves, which again will vary, but will be capped at 0.75% per annum.
And that member charge, just to be clear, comes off the members' funds. It's not something they explicitly pay.
Correct. It just comes off the funds behind the scenes. They do get a statement that articulates exactly what they've made, so it's very transparent. But it just comes off their pension pot. They don't have to dip into their pocket.
Okay, thank you. So the next one is, I suppose probably for both of us, but can you please let me know, do you need to put your staff on a pension from the staging date or from the compliance date? I don't know, Vicky, would you like to take it?
Yeah, so it's from staging date. So as soon as you reach your staging date, that's when your assessment of your employees kicks in.
Great, great. Now this is maybe a bit of a long one, so I might give this to Standard Life. What happens, and I know I briefly touched on it, what happens if my client doesn't comply or is late complying with auto-enrolment?
So this one really depends on how late they are. The big kind of milestones set in the rules are, if they're 6 weeks late, their option to use some of the flexibility such as postponement goes away, and you'd have to enrol staff that are eligible from their staging date, so they have to backdate if they don't get things done within 6 weeks. So if they were, for example, 3 months late, they'd have to backdate their membership 3 months, they'd have to pay 3 months of arrears contributions, the employee would have to pay 3 months of arrears contributions, which the employer will have to have that conversation with their employees. So it becomes quite cumbersome. Beyond that, it just gets harder and harder because you've got more to catch up on, and once you cross that 5-month line, the pensions regulator is probably going to spot it, and at that point they'll start doing various notices that might escalate to fixed penalties and fines, depending on how quickly you get on top of it and to what extent they determine you've made a reasonable effort to keep on top of things.
It's kind of, I mean, the way I articulate that, is, I guess, then is if you're within 6 weeks late, then you have some options as to how you deal with it. If you're beyond 6 weeks, then you're going to have to backdate. So the longer they leave that, the further you'll have to backdate, the worse it's going to be.
Yeah, exactly.
Am I right in thinking as well that the pensions regulator can actually make the employer cover all the contributions if they're over 5 months late as well? I think we've heard that happen to some companies.
Yeah, very true.
The employee's fault.
Yeah, it's largely the TPR's discretion, and it might depend on their perception of the employee's ability to pay. So you can imagine if you were 5 months late and you were going to go along to employees and say, give me 5 months of weekly pension contributions in a lump sum, I will take it off your pay in a lump sum. It's a difficult conversation. For some staff, depending on their situation, that could have a very significant impact. And yet we have seen it on a regular basis. The TPR turns around and says, Mr. Employer, you cover all the arrears, so you pay both the employer and employee. And in some circumstances, they've even made them add interest to make sure the member's not lost out. So it kind of, Jamie's alluding to, the later you are, the worse it gets. And the probability of the employer having to pick up additional costs, such as employee premiums and or fines, the likelihood increases.
Okay, I think the key message there is don't miss your staging date if possible. Yeah, there's just a follow-up question actually on that point. Sorry, Karen, if I just jump in here. Somebody's just asking, can BrightPay handle missed staging dates? And we can. From a software perspective, you can reopen your pay slips back. You can trigger the auto-enrollment and the pension contributions. What we would say, though, is always check with the pension provider. Some pension providers allow you to upload then historical contributions files, which that would create. Others require you then that the missed contributions be put into, I suppose, the next current contribution file. How does Standard Life work? Can you accept historical files or?
So it depends on the circumstances. We can accept clients that miss their dates, and yes, we can accept historical files. We can also just fix forward, as in on the next payment schedule, you just pay the arrears as a one-off extra payment. So there's different ways of going about it depending on the specific circumstances. What we'd encourage clients to do is give us a call. We'll look at the state of their particular scheme and give them a view of which route is probably going to be least painful for them.
Okay, okay. Good to know. Thank you.
Okay, so just a couple of quick ones here for BrightPay. Does BrightPay support Royal London? Yes.
We do. Yes, we do.
How much is BrightPay Cloud? I'm going to bring it up here because there is discounts for bulk purchases for Payroll Bureaus. So your single employer is £49, and then we have different packs and different discounts and percentage rates, and you can see the cost per employer there. So yeah, £49 per employer or per client. And I suppose the advantages of the bulk discounts is that you can, get the discount and then charge your client the full price of £49. Okay, so the next question is, can you send letters to employees before the staging date? So no, you send the letters or the communications to all employees at the staging date because they have different options there, like that they're being enrolled, and eligible job holders will have the option to opt out. So if you send it before you reach the staging date, then the pension scheme wouldn't have been set up. They won't have the option to opt out. So what you'll do is you send your communications on the staging date.
Can I just add to that one?
Yeah.
So absolutely, totally agree. If you're doing the regulatory minimum, the communications and the auto-enrollment rules require, send them from your staging date. But there's nothing to stop you writing to your employees in advance to tell them about the pension scheme. You're perfectly entitled to invite them to join earlier if you want to get ahead of your duties. So There are some deadlines, but if you want to, you can encourage employees to find out more about the pension scheme in advance.
Okay, thank you. So maybe this one here is for Standard Life. I might give this to you. So do you have to set up a pension scheme if you have no eligible employees?
Yes, to a point, in that one of the first communications you're going to send to your employees is the right to opt in even if you're not eligible. So having a pension scheme ready for those employees to join if they do opt in is important. Having said that, you could make a pragmatic decision based on the particular employer, the nature of the workforce, the likelihood of people opting in. At Standard Life, for example, we can set up a pension scheme in 6 minutes. So if it was very unlikely you were going to have any pension scheme members, I would suggest you would maybe just wait until somebody opted in, but know where you're going to go if somebody does opt in, so you're prepared and you can just charge on. If the likelihood is it's just a matter of time before somebody's eligible, I would recommend you charge on and set up a pension scheme. If you're doing that, if you're setting up an empty scheme, do check with your choice of provider how they charge. So for example, Standard Life doesn't charge a penny until there are members, so that monthly charge I mentioned before would not apply until there was a member enrolled. Other providers will charge you up front regardless. So make sure you do your research to see when charges kick in if you're going to set up an empty scheme pending membership.
Okay, so I have another one here for Standard Life. If a new employee joins a company and already has an AE pension set up with a previous employer, would it be okay for the employee and the employer to pay into this pension, or do the employees have to pay into the same employer's pension? So that's probably a common question that we get.
So there's a degree of flexibility. From the employer's perspective, they need to have a pension scheme for each employee that's enrolled. Typically, for admin reasons alone, they'll put one pension scheme in place for the entire workforce. But there are options to use individual plans that key people have elsewhere. So for example, it's not uncommon for a business owner or director to perhaps have an individual plan, perhaps a self-investment plan for themselves, and maybe have a pension scheme for the majority of the workforce. It will create a little bit of extra admin because they're sending money to different pension schemes, but it might suit the needs of particular individuals. So it's really at the employer's discretion to what extent they start breaking up the pension arrangements.
Okay, thank you. So this one might be for Vicky. How do you know what to put? How do you know what to put in the tax relief question on BrightPay, or the tax relief tab? I'm sure.
Okay, so yes, when enrolling an employee in BrightPay, one of the questions you have to answer just using a drop-down menu is what tax relief method is in operation. If you are unsure of this, always check with the pension provider first of all. Some pension providers, I'll just use Nest as an example, only offer relief at source. So where we know there's only one tax relief method in operation, we will give you that as the default. You know, you can't change that. So, I mean, those are, I suppose, are the easier ones. Some pension providers offer both net pay arrangement and tax relief at source. And when setting up your scheme with them, that information would be to hand. If you are unsure, so where those options are both available, always just revert back to your pension provider and check with them, because obviously it's important to get it right from the word go.
Okay. Thank you, Vicky. So I might pass the next one to you guys. If a new employee already has a personal pension, do they need to be auto-enrolled?
Yes, similar to my previous question. Typically, yes, they do, as in the personal pension is unlikely to be a qualifying arrangement. It won't meet some of the rules such as price cap and default funds. So typically, yes, they do. However, in exceptional circumstances, it might be possible to have the individual personal pension marked as a qualifying arrangement if the employer is willing to take on the extra admin.
Okay, thank you. Okay, so this one here is for BrightPay. So does BrightPay automatically notify you of re-enrollment?
Okay, so yes, we're talking about enrolment here, but also we've got employers who are coming up to re-enrolment as well. So in our 17-18 package, we are going to cater for re-enrolment, and how it's going to work is that it's going to be a manual date field. Because you have a 6-month window for re-enrolment, BrightPay doesn't know what date you're going to do that on, so we're going to leave that up to the user to manually enter their re-enrolment date. When that re-enrolment date is reached, then obviously BrightPay will kick in and will be as automated as possible for you at that point. So yes, 17-18 will have that in it.
Okay. Does it matter, this was for BrightPay now again, does it matter how many employees an employer has for BrightPay Cloud? So no, it's unlimited amount of employees. So one license will cover one employer with unlimited employees. Okay, let me see the next question. Is there any way of obtaining an exemption for payments which exceed the threshold, particularly thinking of seasonal workers? Seems a bit daft to enroll them for one pay period.
Yeah, I can take that one. Yeah, so I suppose this is where you could use postponement. Postponement is, a good way, just to deal with seasonal workers' probation. I know we have a question in there just about probation as well. So yeah, so we would kind of advise use postponement there.
Okay. So next one for Standard Life. How can an employer switch from their provider, e.g. from Nest to Standard Life?
Actually, auto-enrollment makes switching pension providers much easier because there's a rule written in the regulations that basically says if you stop one pension scheme, you must automatically enroll employees into a replacement scheme. So that the employers used to need to get members' consent to put a new scheme in place. Auto-enrollment now allows the employer at their discretion to put a replacement scheme in place. There's a few details around making sure there's continuous membership, continuous payments, so there's no member detriment. But actually, yeah, the new rules make it very straightforward for an employer to choose a different pension provider.
Okay, perfect. If the staging date is the 1st of February, when are the first contributions due? Vicky?
Okay, yeah. I suppose what we don't know just from this question is whether you're weekly or monthly payroll, but yeah, it tends to be then obviously when the 1st of February, the pay period in which your 1st of February falls, basically. We'll keep it quite simple and get into kind of pay reference periods and things here. What can happen, I suppose, with BrightPay, it's kind of programmed according to tax weeks. You could find that, your staging date falls, and if it's a partial pay week, your contributions, even though you're being assessed and you're being enrolled, your contributions might not kick in until the next full week after that. So it's just something to be aware of, and it's perfectly fine. But yeah, sometimes people expect contributions to kick in straight away, but they might not, just due to your tax weeks.
Okay.
There.
So this might be one for Standard Life. If both employee and the employer start off paying 1% each contribution, and the employee wants to increase their contribution to 5%, does the employer have to increase their contribution?
Good question. No, they don't. It's, again, a little bit at the employer's discretion. Back to the point earlier, the auto-enrollment rules being the minimum. So right now they say the rules say the employer must pay a minimum of 1%. They could allow their employees to pay anything they like above the current employee minimum. However, what we typically find is a lot of employers will kind of position this as maybe as a partnership. If you pay 2, I'll pay 2. If you pay 3, I'll pay 3. The employer might still cap their contributions at whatever they consider reasonable and affordable. They might say, I'll match you up to 3%, but above 3%, you're on your own. You can pay what you like, Mr. Employee, but I will only match up to 3%. So it's very much down to the employer. They don't have to pay more than the minimum, but it's very common for them to have some kind of matching arrangement.
And the minimum employer contribution at the moment is 1 that goes to 2 next year and then 3 in 2019, doesn't it?
It does indeed. And it varies slightly depending on your choice of pensionable pay definition. It's 1% higher if you choose basic pay. So really, again, it depends on the employer's objectives. Are they trying to do the compliance minimum, or are they trying to provide a valuable benefit? So it's very much something the employer can choose to design themselves as long as they beat the minimums.
Okay, perfect. Okay, there was another question here for Standard Life. I'm not sure how short the answer is going to be, but can you cover off again the option employers have for contractual enrolment to avoid assessment, making admin easier?
Yes, so this is about the little rule that says auto-enroll people unless they're already in a qualifying scheme. And kind of tying back to that question about when you have to contribute and how quickly you have to enroll people. Everything kicks in at staging date or the date somebody joins company. If the employer's found a way of getting somebody into the pension scheme quicker, all that stuff about assessing and deciding when you join them is taken care of. So a common and relatively simple approach is to put into the contracts of any new hire that by accepting this contract, I'll pay you this salary and I will put you in the pension scheme and this will be the contribution basis. It doesn't have to be particularly complicated, but if you want to check with an employment lawyer, a little paragraph that says I will automatically put you in the pension scheme when you accept this contract of employment is enough to give the employer the right to automatically join rather than automatically enroll somebody into the pension scheme immediately. It takes away all the effort from assessing them and figuring out if they're eligible, non-eligible or entitled. So if the employer's objective is to get a quality pension scheme in place and get everybody in as simply as possible and get them on a standard contribution basis, putting that little paragraph in their contracts might be a shortcut.
That can be used to facilitate salary sacrifice as well, can't it?
It can indeed. It's a really good way of just putting everybody in on the basis the employer wants. The only difference is salary sacrifice. So the pension you can't opt out of until you're in. One little nuance to be aware of with salary sacrifice is you can and must let the employee say in advance that they don't want it. So there are some people where salary sacrifice would not be a great idea. For example, if it took them below the national insurance lower earning limit, maybe not a good idea. If it took them below national minimum wage, not a good idea. But apart from that, if you've got staff with national average earnings, salary sacrifice is a real win-win for the employer and the employee.
Okay, thank you. So the last one here. Okay, so does the employee's 1% contribution have to be calculated on their total wage, e.g. basic pay, overtime, bonus, etc.? Vicky? Or?
I just think it's a follow-up there for Standard Life there.
Oh,
I think,
okay,
yeah,
sure,
just
yeah.
to the quick question before.
So you've got some choice. So for assessment purposes, determining when you ought to enroll somebody, you pretty much have to use their total pay, pretty much everything that be on their P60 as a broad rule. When it comes to their pensionable pay, the earnings you work out their contributions on, you've got a degree of discretion. You can use total pay, which will take you up to a minimum total contribution at 7% after phasing. You can use basic pay, which will take you up to a minimum of 9% post-phasing. You can use qualifying band earnings, which is the absolute minimum. That will take you up to, it's 1% now, and it will take you up to the 8% post-phasing. The qualifying band earnings, kind of as it says in the tin, is a defined band of earnings between basically your NI band. anything in there is your pensionable earnings. So you chop off the first 5,700 odd, and chop off everything above 42,000 odd, and you work out your 1% on any earnings in that band. That will certainly give you the smallest contribution in most circumstances, but bear in mind it also means the smallest pension pot and the poorest outcomes for the membership. So choose that one with caution. And there is a fourth option that's a little bit more complicated, that allows the employer to be a bit more specific about exact what elements of pay they want to use. I'll not go into it today, but it's just something to bear in mind. There's one that is a bit more flexible, that allows the employer to choose the pay elements.
Okay, so I think we just have one more question here before we finish up. With BrightPay Cloud, could subsequent users have different levels of access? E.g., one use is restricted to just leave requests. Vicky?
So at the moment, I suppose there's two levels of access. There's administrator access, which I suppose from a bureau perspective allows that user, that administrator, to access all the companies in BrightPay Cloud. You can then give access to what we call a standard user, which is at company level. What we haven't gone down the route of doing yet is just within that company level is to then restrict what that user can do. I'm not sure if it's in discussions. I'm not actually sure. Oh, sorry, it is. Sorry, I'm getting a nod to say it is. That that we're working on that. It's just not available at the moment. Okay.
Okay, everyone. So we're on the 12 o'clock mark. So just in time for finishing up. I think there's no more questions come through. So thank you to Jamie and Graham from Standard Life, and thank you to Rachel, Victoria for today's webinar. Their contact details are on the screen there should you have any further questions. So thanks so much, guys.
Thank you.